thank you to KHL for inviting me and to the sponsors for making this day possible. I'm not sure what the wisdom of you want to kick off your day with an economist, but we'll try to make this interesting. Actually, economics is the dismal science, as they call it, and for the past 5 or 6 years for this industry, it's been kind of dismal. I think not a bad 2012, but for the most part, a pretty grim outlook for the past few years. It's getting better, though. So the key takeaways from today, in terms of the macroeconomic outlook, is that we're seeing gradual improvement globally. Some markets better than other ones. We'll get to that in a second. But in particular, developed markets are now going to lead the charge. We actually have some challenges, I think, in emerging markets coming forward. Key to our forecast is an improving U.S. economy, improving housing market, which will eventually create the knock-on effects of an improved non-residential market. The Eurozone's long recession is over, but the recovery is going to be quite slow. In fact, even the U.S. recovery has been quite slow. The problem we see in emerging markets is that the extreme monetary accommodation, that is almost printing of money, has made it rather attractive to invest in emerging markets as opposed to developed markets. As you can see, an increasing return coming with higher interest rates in developed markets. That creates more competition for funds for emerging markets. The other major construction market, apart from the U.S., is about 15% of the global construction market. China is also about 15, a little more percent. Growth has stabilized there. There still remains some challenges that we'll discuss in a minute. And the other thing to take away is the commodity super cycle, that is the price of oil, natural gas, copper, is over. And that's good news for the standpoint of inflation, but it's bad news for emerging markets. If you think about the events that drove such great growth in Chile, Peru, Brazil, Africa, it was high prices for copper and other metals that made investment attractive, created the need for infrastructure spending. Well, with prices stabilizing, that heat from the burner is going to be somewhat diminished. So for the emerging markets, there's some structural problems and then some cyclical problems that are going to slow growth. We have growth still, just slower. First of all, as I mentioned, if the developed world is offering you rates of return of 0.25% on a U.S. federal funds rate, and you can afford to take some risk and go into emerging markets. As the return on a quality investment increases, that will suck some of the money out of emerging markets. And then frankly, if you're actually kind of printing money, it has to go someplace, it will seek a high rate of return. As we cut back on that money supply, you're going to see it fall back to safer havens. Secondly, and I think equally as importantly, in many emerging markets, this money came in from foreign direct investment, and it was invested quite wisely. Much better underpinnings of these markets today than there was, say, 10 years ago. Financially, fiscally, trade. One thing didn't happen, though, and that was typically a liberalization of trade policies. So if you look at Brazil as a classic example, with its barriers to entry, you have a problem now that as economies pick up, it's hard to do business there. It's hard to do business in India. It's hard to do business in South Africa. And so these lack of reforms are going to hinder growth in the long term. And then finally, just the overall pace of globalization has slowed. If you think about trade from emerging markets to developed markets, in general, that growth has slowed down. China is no longer as cheap a place to do business as it was 15 years ago. So some companies are bringing work back home again, and that kind of slows the need for investment overseas. So bottom line is that growth on the scale that we saw in the early 2000s in emerging markets is not real likely. However, the growth opportunities remain primarily in emerging markets. This is look at the GDP growth globally. And you see NAFTA, North American free trade. There is certainly a recovery over the next 2 years. This is GDP growth, not construction growth. Latin America doing even better. Western Europe certainly improving out of recession, but you see the growth rates here at 1 to 2%. They're not going to be growth leaders in the world, as it were. Eastern Europe doing somewhat better, but look at those really big bars in terms of growth. It's coming out of the Middle East, and especially Africa and on the non-Japan Asia. So, next takeaway, what happens with the global construction outlook? Well, if this thing went back into the 2000s, you would see some growth rates that are 5 to 6%. So the good news is, next year looks pretty good, around high 4%, pushing 5%, falling back a little bit in 2015 to more like 4%, and then declining in growth as time goes by. No recessions in this forecast, but declining growth. In fact, it takes a lot to get the actual contraction in a global construction market. Since 1990, the first global contraction was, in fact, in 2008, this so-called Great Recession. So the good news is better growth coming, but not what we saw in 2005, 6, and 7. Looking at the building types that we see doing well, certainly they all do better next year than this year, because this is not a great year. Depending upon the building type, 2015 can be a little bit better. So residential is better, mostly because of the US. Non-res, you see a declining rate of growth, but still quite strong. And infrastructure, roads, bridges, and so forth, also declining. But if you think about that, many economies engaged in counter-cyclical spending to improve their economic outcomes. And as things improve on their own through the private sector, you can wean off that counter-cyclical spending, so you get some reduction in growth in infrastructure. I don't want to spend a lot of time in Europe because we're here. I think you kind of know your own backyard. But from our own perspective, in terms of an outlook, we do see recovery in the Eurozone. It's gradual and frankly fragile. Unemployment remains high. Fiscal realities remain present. And tight credit is going to remain, we think, for another couple of years, at least tighter than it had been in the past 10 years or so. UK, one of the bright spots where economic activity has picked up. There's been certain incentives to boost residential construction and infrastructure spending. So there's some brightness there with, of course, the caveat that it's a pretty mature economy, there's only so much potential. And the German economy is also a pretty bright spot, restrained by weakness in the overall Eurozone, but certainly has the advantage of a high-quality, export-driven economy in a world where the Eurozone is still relatively cheap, and therefore remains quite competitive versus competitors such as Japan and the US. Looking at the near-term growth, you see the country, I presume you guys get this presentation, so I won't go country by country to save some time. But you do see a story here that 2012 was quite bad for most of Western Europe. 2013 has not been all that kind either. And in fact, 2014 we see some growth returning, principally in Germany and the UK, but most of the countries in the region are going to have some recovery in 2014. As we move to the medium-term outlook, this is a 5-year compound growth rate. You see that the region as a whole has got a gain. The UK has got the biggest percentage change, much of that residentially focused. And then Spain, because of the depth of the recession, it actually does have growth in 2015, and at the outer years of this forecast, the hole is kind of big. And so same with Italy, that by the end of this 5-year time frame, they haven't quite gotten out of the hole, hence the contraction over the 5-year growth rate. Eastern Europe really is a tale of Russia and Poland. As you can tell, this is about 3/4 of the Eastern European economy. Russia is constrained by, well, a corrupt economy, basically, so very difficult to do business. But more important, oil prices, in our view, are stable at about $100 a barrel. They're not going to increase a lot next couple of years. And Russia is certainly a resource-intensive and energy-intensive economy. Absent that kind of development, it's hard to see a really strong growth rate of more than a couple percent, maybe 3% out of Russia. Poland, a little bit weaker, certainly has benefited from ties to Germany, and the success of Germany has helped Poland. But I think the best growth rates for Poland were the high single digits the past 5 years until this year. I don't see those coming back again. We're looking at growth in the 1–2% range. And most of Eastern Europe is looking at that kind of a constraint tied to Western Europe. Now, spend some time on the more developed economies, or less developed economies in the case of Asia, but for the US, we have a very strong outlook in terms of growth rates. I want to put in perspective, our assumption in the US is that housing recovers, and recovers quite robustly, but the key here is this chart. You see a healthy U.S. economy is about a 1.5 million housing start economy. In a recession, we were building houses at about a 500, 600,000 unit rate. So as the employment picture slowly increases, and by 2015 we hit a new peak of employment in the U.S., we reinvigorated household formation. The housing starts come back to where's a healthy level. That 1.5, 1.6 million unit rate is not an extreme level, that's actually a healthy level for the U.S. economy. So we're looking at very strong growth from a very deep hole, creating what is a sustainable market for housing. The knock-on effects from that occur about 18 months later. If you follow the American Institute of Architects survey, the most recent number is out yesterday, I believe it was, showed, once again, expansion. So this forecast is looking quite real. Commercial building picks up in 2014, but really takes off in 2015. That's when the employment levels get to the new all-time high. We work off our excess capacity, high vacancy rates, and actually need to put new holes in the ground and pour some concrete and make some new construction as opposed to just renovation. Manufacturing has had its best years in terms of growth in 2012 and before, but certainly looks good, relatively speaking, for a mature economy with 2-4% growth coming up. One of the keys in the U.S. forecast is the so-called unconventional gas and oil. In the longer term, that drives some very serious manufacturing spending on construction as we need to build the processing plants to take this relatively cheap gas and oil and turn it into other feedstocks. So 2016 and beyond, you see a stronger growth rate in manufacturing as opposed to commercial. In the near term, though, natural gas prices are quite low, and absent a very cold winter will remain low, and so the actual drilling of new stuff we think is going to basically plateau. So this is a modest negative growth rate in 2014-15, but from a very high level of activity. So still a pretty healthy market. And you see anything involving infrastructure or public spending has got a pretty weak outlook in the U.S. because of our fiscal mess. And we all see that in the news, I think, most weeks, so I won't go there any further. For Latin America, the outlook is somewhat, I would say, gloomy compared to what we used to be seeing. Relatively weak global economy. The commodity prices have certainly prevented external demand being a big growth driver. The disappointment has been Brazil, largely because of its regulatory and business framework. The highest rate of construction wage inflation in the world is in Brazil because we've got too few skilled workers chasing too many projects and we can't get them all built. So even with these great investments for the World Cup and the Summer Olympics, that's just taking workers away from someplace else in the economy, which might even need it more. So it's growth, but it's muted. In Latin America, basically, if you're an economy that's got a free market mindset, Colombia, Chile, Peru, you've got a very good outlook. If you're a resource national intensive economy, Venezuela being the worst case, but Ecuador, Argentina also being cases, you've got a much less good outlook. And you see here the Latin American market with Brazil at about half the market. The other economy is much smaller, but then the growth rates where Brazil actually outpaces the market in 2015, but for the next couple of years going into that, relatively slow growth. And you see certainly the two-tier system of Argentina, Venezuela, with much less opportunity than the other ones. And Panama is a canal zone issue. It's rebuilding of the entire subway system in Panama City. That's not exactly a huge construction market. Many of those contracts are now locked down. I just want to put infrastructure in perspective in Latin America. In the 5-year compound growth rate, Brazil is a very average-looking economy compared to the rest of the world. Actually, Colombia's got better chances, prospects than Brazil. So I just want to keep in mind, we hear about the BRIC countries, Brazil, Russia, India, China. To me, Russia and Brazil are not quite the same league as India and China. In the global construction outlook, we look at risk relative to reward. So this is a classic chart we use. The risk scale goes from 0 to 100, 100 being the Sudan, very, very high risk, 0 being no risk whatsoever. The growth rate, 5-year compound growth. Size of the bubble is the size of the construction economy. And the key here is to take a look at economies that fall into quadrants. Upper right, high risk, high return, so Bolivia. Bottom right, you want to avoid high risk, low return, Argentina, Venezuela. Lower right is what you'd expect, low risk, low return, Costa Rica, Uruguay, Brazil is on the cusp there. The things which are interesting are that the economy is offering you above average growth and below average risk. So Panama, Chile, Peru, Colombia, these economies you should take a look at in Latin America. Of course, pay attention to level size for your market opportunity. Asia Pacific certainly has the best growth prospects in the world in terms of size and growth. You see China and India outpacing the region. That's not a big surprise. Indonesia also would outpace the region. We'll see it in a second. The key here is growth typically accelerating across all these economies, with the exception of China with a bit of a up and down cycle, and Japan, where you see the earthquake rebuilding effect in the near term, but longer term trailing off to what is for Japan a long-term growth rate of about 1%. China is the biggest construction market by far in the region. You hear they have overcapacity, and they do. They have a housing bubble, and they do. But if you look at the 5-year plan, there's still opportunity. And in a nutshell, we're looking at a transition from an export economy to a consumer-driven economy. That's a change in manufacturing to services. That means new construction. We're moving their focus of activity from the coast to interior provinces. So you need new construction on the interior as opposed to the coast. And we're moving from an economy based upon things like steel and coal and heavy industry, which there is overcapacity, to an economy based upon green energy, aerospace, biotech, where there is not a lot of current facilities. Therefore, new construction and manufacturing still occurs, just different than occurred 5 years ago. And on the case of residential, yes, in the private high-end marketplace, there is overcapacity, but at the so-called social housing, when you consider the pace of urbanization, there's still some growth opportunity in that sector. So you see residential spending, China still leads the region and the world. No, it is a region, it doesn't lead the world, but it's well above average for the world. Now, India also has a very high growth rate. I want to caveat India. The assumption there is that they engage in some kind of regulatory reform. We've seen it in airports. We've seen it in retail. If you look at their 5-year plan, where they have made hits and misses, they made the target for airports, they missed the target for rail and highways, because a foreign investor can own over 50% of an airport, they can't own over 50% of a toll road. Similarly, in retail, you can own a mall if you're a foreign investor in a city of over 100,000 people, but you can't own an office building. So our outlook for India is fairly robust, to the degree that they failed to engage in some of this opening of their markets. The outlook becomes a little less strong. That's especially true for infrastructure, where as a nation, India runs a long-term structural deficit, much like the US. The difference is you'll take a risk on a dollar, you won't take a risk on the rupee, and so you can't maintain that level of spending from the central government. You have to have foreign direct investment. And that means you have to have some mechanism to create public-private partnerships. That means you have to have some measure of allowing those private entities to control their investment and repatriate earnings. So Asia Pacific, with our handy bubble chart, Pakistan is the awful market with low risk and so high risk and lower return. India is relatively safe. This is a risk score based upon the risk of a long-term investment. So can I repatriate earnings? Can I force a contract? Can I protect my intellectual capital? What's the chance for labor force and the rest? These are all pretty good in India, in spite of other risks that might be there. So India is a relatively low-risk country with a strong return. New Zealand actually has an earthquake effect from Christchurch that's not going to be there probably 2 years from now. In the other spectrum, Indonesia, Vietnam, China, Bangladesh. Now, Bangladesh is largely a World Bank financed situation, mostly infrastructure spending. Vietnam is tiny, but has very good growth. My favorite actually is Indonesia. It's an economy which has got vast natural resources. Coal India has been a suggestion they should be importing more coal as opposed to just producing it domestically. There's a big chunk of coal to the south of India called Indonesia. Yes, good news for port work. There's also a lot of natural gas that South Korea would love to have for clean manufacturing. In fact, even in Indonesia, they're looking at manufacturing requirements to boost natural gas consumption. The problem is the gas is in the northeast and the manufacturing is in the northwest, southeast, which means either put a pipeline across the country or else more likely what they've been doing, which is compress the gas, put it on a boat, move it, and then use it manufacturing there. So lots of good things happening in Indonesia. The only roadblock there, frankly, is much like India. They've, a very rapid pace of reform has slowed down in terms of their economic liberalization. And finally, I want to cover Middle East and Africa. Fairly stable outlook, about 3% growth the next couple of years. Certainly political unrest has been a problem for Egypt, Tunisia, by extension, Jordan. However, many of the economies, the UAE, the Saudi, have benefited from sort of counter Arab Spring spending. That is, this region has got amongst the highest household formation rates in the world. Young adult males who are unoccupied are always a problem. You add to that some religious fervor, and you get a bigger problem that we saw in the Arab Spring. So how do you solve that problem? Well, you create some housing, you create some jobs. And so Saudi's been the best at that in terms of industrial cities, but the UAE certainly has a rejuvenation of their commercial development. The biggest growth comes from Bahrain and Qatar, but those are relatively small economies. And of course, Iran, with sanctions in place, in our view, for some time, has got the weakest outlook. And you see here the non-res investment picture with the UAE in the clear lead, primarily Dubai, primarily rejuvenation of projects that were put on hold in the Great Recession. What's interesting in this section of the world is you almost never see a infrastructure spectrum where the biggest spending is water and sewer, public health. Typically, in emerging markets, the biggest thing is transportation. So this is a region where two things are happening. One is you've got rapid growth of commercial buildings and industrial buildings in key countries like Saudi and the UAE. They were underinvested in their facilities in the great expansion. But more importantly, energy prices are basically at $100 a barrel for oil. So the need to have that massive investment in energy-intensive infrastructure isn't there. It's going to get spent in the public health and the transportation arena. And the leader here actually is, of the big economies, is the UAE. In our favorite risk reward spectrum for Africa, we'll get to Kenya in a second. So basically the high reward, low risk economies, Qatar, Bahrain, Saudi, UAE, it's pretty good prospects in this region for safe growth in terms of business risk. The only really bad spots are where we know they are. Iran, of course, off the chart, and actually unattainable to many of us in the room. Egypt and Tunisia are also obviously high risk. Now I wanted to touch on Africa before I concluded the remarks. If you're thinking the long run, and population is one indicator of the long run, the fastest growth is not necessarily in Asia Pacific. In fact, it isn't even Asia Pacific, with a one-child policy which may not be liberalized, but with a one-child policy, China in 20 years is France, demographically. So that's one reason why I suspect they changed the policy, is to improve long-term prospects. Even so, people who are born today are our workforce in 25 or so years. And you see here the Middle East, and especially Southern Africa, are where we're going to be seeing all the growth in households in the future. Now, we all know the problems with Africa. It's not stable politically in many cases. The economies, in some cases, are horribly managed. But take a look at things like Cameroon, where you see a structure of its investment code that actually treats foreign investors equally with domestic investors, and therefore it becomes a relatively safe place to make investments. You take a look at Mozambique, for example, where you've got massive natural resources on the interior and no means to get that to market. So $20 billion going into ports and railroads. My favorite, Kenya, with a silicon savanna, that is the Silicon Valley of Africa, which actually is on track to hit these goals of 20,000 employees by 2015, 20,000 by 2030, The challenge with all of Africa is how do you take this natural resource wealth and turn it into an educated workforce? Kenya can do it because they actually have an education system to produce the engineers for high-tech products. Most of Africa doesn't have that luxury, and so we have to hope and plan that as the money flows in, it is reinvested in the economies to maintain the potential of this region. We don't have a construction forecast for many of these economies. What I wanted to do was give you a different kind of flavor. Business fixed investment is essentially buildings plus equipment. So for your business, it's probably one and the same. This means it's a pretty good indicator. This chart is a good indicator of what to expect in the coming years. And you see Nigeria, of course, as a top prospect, Botswana, Congo, all looking at relatively good rates of growth in the future, with Senegal, Guyana somewhat less strong. And one thing I would encourage you to do is look at that in the context of risk. We have the risk service, as I alluded to. This is actually political risk as opposed to economic risk. Blue is safe, red is not so safe. So one thing you would want to do is perhaps impose the view of construction and equipment investment on top of this kind of a graph and say, yes, I want to put people here, I want to put factories here, I want to put distributors here, maybe I don't want to put them someplace else, but weigh that risk versus reward spectrum. So in a nutshell, we are looking at an improving global environment. The growth rates are somewhat gradual. They're going to be better than they've been for quite some time. It's not as good as the peak of the market in 06 and 07. The best growth remains in emerging markets, just scaled back a bit. If you think about it, China at 10%, it's now at 8%. Brazil at 6% is now about at 4%. So take what we used to see in the peak of the market, subtract about 200 basis points. That's your outlook for emerging markets in the near future. So I'll be around today for questions, but I want to make sure we stay on schedule. So thank you for your attention. Glad to be here.